a trade, I think, is broken into 4 parts. I call this the 4S framework. So it's like setup, the reason when I want to be long or short. Then I've got the signal. Then I've got the stop. And then I've got size, as in the position size. The setup, the first part, I want to be, although it's rules based, because all of the components, like I mentioned before, the fundamentals and the technicals is rules based, but I want to be keeping like a discretionary element to it as well.
Well, thank you very much, Alex, for joining us here today. I'm super excited to catch up with you. I've been a longtime fan of the MACD indicator and your work in the space. I first learned about you through my work at the to develop or to get my designation through the CMT, and had heard that you won the Dow Award for your work there. And I took a look at it, and I think originally I had created a quick indicator on PineScript, which is how we ended up meeting. So I appreciate the connect and excited to learn more. So maybe just to get started here, if we could just learn a little bit about your background as a trader, how you got started, and really what you're trading these days, and how you're profiting from markets, that would be great.
Absolutely. Mike, thank you, first of all, for the opportunity of this interview. We've been in touch via email for a long time now, and I've always enjoyed our communication together. So thank you for the interview. And
I appreciate it.
okay, how it started. Well, you're taking me a long time back when from well, let's say from a child around 13, 15 years old. Um, my father was working for Bank of America. So he was in corporate finance. He was working in Greece, and one day he was sent for some seminars in England. And then he visited the bank's dealing room. He got impressed, and then he came back and he said, "Look, son, I think it's best if you go into trading." And like just like any other son who wanted to impress their father, I said yes. Of course, I had absolutely no idea what it was, but I've always kept it at the back of my mind. So that was my first impression. Now, over the next few years, I found that I liked economics. So I went to university, went to London, to City University, and did banking international finance. And then I started seeing that I gravitated towards capital markets. So my dad's wish kind of like was a bit of like a prophetic. Um, right at the very end, the last year of my university degree, there was an elective course called forecasting. It was taught by one of my then professors, which I'm still in contact with, called Roy Batchelor. Roy was a trader at the pits back in the day, and then he made a career change and went into university in academia. And he wanted to teach technical analysis because he was a practitioner. He wasn't like a pure academic. But at that time, when I say that time, when I was in university, I was 1995, 96. Um, that was a long time ago. This year I'll be turning 50. So that was a long time then. Um, he wanted to teach it, but because it was considered kind of like heresy in the academic world,
Hmm.
so what he did is he took technical analysis and he packaged it really cleverly. He put some maths at the beginning, some maths at the end, and he made it into econometrics course, forecasting
Mm.
course. So as that was my first look at technical analysis, and I immediately fell in love with it. So that was it. I mean, finished my degree, went home, did my military service, and then I started working. Came to England again, worked for proprietary trading houses, for a couple of hedge funds, and then I decided to go solo, move to the south with my wife, and we have a very nice house, about 10 minutes away from the English coast,
Mm.
and I'm trading on a proprietary basis for a long, long time now,
Hmm.
and also launching my own company. So that's the short version of my life. In the meantime, of course, also got involved with the CMT Association.
Hmm.
I founded the UK chapter in 2010. Then subsequently got involved. Also created the Greek chapter with another two people, being with three of us were co-chairs. So that's the brief version of my life story.
Of a wide spanning career. I love it. And very interesting the background with your father there. I feel like I had the inverse. My dad told me, "Don't get involved in markets, you'll lose all your money and it's not worth it. Savings accounts are a better way to go." And I was very defiant of that path. I had more interest in the originally the quick profit that could be made in markets, and have since understood how long-term approaches have
Well,
been
your
much more
father
useful.
understood risk. That's the thing.
He
He,
did.
he
He certainly
probably
did.
was wiser than mine, because mine was like throw me into the lion's den.
What
So
did he
no,
have
it was.
you what did he have you trading when you first started?
When I got my first job, I started with equities.
Equities, okay.
Yeah, and I speculated on a merger and a bank merger, and I got it the wrong way. So my first trade was a losing trade.
Oh, no. Well, that's a good way to start. If you still went with it, then, you knew you caught the bug at that point.
Yeah, absolutely, absolutely.
That's great. So even at that age, you were doing a little more fundamental analysis than just looking at upcoming mergers and acquisitions, or what was your thesis, for a trade?
When I started, like I mentioned, because I fell in love with good question. From the university thesis, when I was in uni, I did the fundamental factors affecting the London Stock Exchange. So I was like
Mm,
looking into like dividend policies and things. But as soon as I did my technical analysis, then I never looked back. But I found that technical analysis was a great timing tool, invaluable. I could never understand why people look down on technical analysis. They just dismiss it. But I found that it was a bit lacking of information, in the sense that it answered the question when, but not the question why.
mhm,
The why was a fundamental question. And I've always felt that there was a bit in me that was not getting satisfied through technical analysis. I mean, I had questions that it could not answer. So that's how I started looking for other tools to help me answer these questions.
right, right. Yeah, I think that's the right way to look at it. And I agree. I think technical analysis in general measures markets quite well, but that measurement should be coupled with something that is understood about why markets are moving in the direction that they're moving and what's driving that behavior, right? So, would you say that sentiment also plays a role in a lot of your work?
Yeah, absolutely. I think market sentiment is a big factor
Hmm.
to look at, because it's inversely related to liquidity. The more bullish at the extreme, because I think, market sentiment is very important at the extremes,
Right.
because when you have extreme bullish sentiment, that means that people are invested, fully, so there's no one else to invest.
Hmm.
So, and on the flip side, when the sentiment is extremely bearish, that means that there is a lot of cash in the sidelines.
Right.
So market sentiment is extremely important, and this is actually one of the factors in what I call the multiple time frame, multiple factor approach I created through the years. Because my next question was, okay, so the first one was, okay, use technicals. Then I went into the fundamentals. So the third stage, I mean, roughly the third stage was, okay, so how do I put this in context? Because you've got economic data, the unemployment, economic production, inflation,
FOMC
and so on and so
report.
forth.
Sure. Yeah.
Absolutely.
Hmm.
And then you've got the commitment of traders report. Then you've got intermarkets, but these are ones are on the monthly chart. These are some on the daily chart, some on the weekly chart. So I was feeling a bit confused at some time.
Mm,
So at some time, then at that point in my career, I started having like an epiphany, and I said, "Oh, that's how it works." And I created a multiple time frame, multiple factor approach. When I started realizing that each time frame has its own return drivers. So on the monthly chart, I was looking at different factors. On the weekly chart, I was looking at different factors.
mhm,
And on the daily chart, which was my execution chart, then I was doing my technical analysis.
mm. Yeah, that makes perfect sense. And coupling all that together. And I think that That I've seen that quite a bit, where higher time frame analysis should serve as a an overall filter and bias for overall direction in the market. Is that the case for you as well, where you're using the higher time
Absolutely.
frame data as a guide?
Yeah, absolutely. So if you look at it as a roadmap,
Hmm.
so on the bottom I've got the monthly chart where I look at the business cycle. Then I've got the weekly chart, which I use commitment of traders report. I use intermarket cycle, which I got from Martin Pring. Then I
Hmm.
look at sentiment and then seasonal slash cycles. So these are my weekly factors. And then I go into the technicals, trend, momentum, volatility, and relative strength.
Hmm. And relative strength as a technical factor, or relative strength to other securities or other assets?
Other assets. Well, there's cross-sectional and time series. Well, I'm looking at as a ranking tool.
Hmm.
So because I have as I mentioned, I trade futures markets,
Right.
and I've got 11 different futures sectors. So within each sector, for example, energies, um, if I get commitment of trade reports, say buy signals on all of the underlying um, markets of this particular asset class, then I want to be using relative strength to see which one is the strongest. On the flip side, if I want to get sell signals, I want to be shorting the weakest one.
Mm.
And it also helps me as an overall, for example, if I want to do a cross asset relative ranking to see which is the strongest futures markets,
Hmm.
it also helps me build rules in the sense that if something is too strong, I may choose to express my doubt, if you will, with smaller position sizing. So that's why, which again might bring me to the next topic. Um, Rather than not just only having a multiple time frame, multiple factor approach, but from an execution point of view, have it semi-systematic.
Right. And for listeners out there, I know I've seen in your work you've described yourself as a quasi-systematic trader. So can we unpack that a little bit? What decisions are made systematically and which are made on a discretionary basis? And ultimately, is it your final say before you put on a trade, or do you have some aspect to your approach in which positions are executed automatically?
Yeah. Well, a trade, I think, is broken into four parts. I call this the 4S framework. So it's like setup, the reason when I want to be long or short. Then I've got the signal, then I've got the stop, and then I've got size, as in the position size. The setup, the first part, I want to be, although it's rules based, because all of the components, like I mentioned before, the fundamentals and the technicals is rules based, but I want to be keeping like a discretionary element to it as well. So and because sometimes, most of the times I would say, the factors that I'm looking at are not everything, is not everything pointing at the same direction. Some will be bullish, some may be bearish, some may be neutral. So it just also takes some kind of like judgmental element. Most of the times it's clear, but there may be sometimes which like conflicting information.
Mm.
So the setup, I want it to be rules-based, discretionary. Now the signal is systematic, which means once I classify a market as being bullish, then I will switch on my signal generating mechanisms, and I will automatically get into the market whenever the signal generating mechanisms get me in. The stop is the same as well, which is the stop loss, and then you've got either take profit or trailing stop depending on the strategy. Again,
Hmm.
it will be automatic. The size will also be discretionary, and that will manifest my, within certain parameters, my conviction in the trade. So for example, as to circle it back to what we mentioned previously, if a market has bearish fundamentals, but it's got huge, it's very high up on the relative ranking, uh, then I will use half size. So for example, one of the strongest markets as we speak, like in May 2024, was cocoa. You may get bearish signals on that, and you get may get good technical patterns, but because of its strength, you might say, okay, even I don't take the trade, or if I do take the trade, I don't have to go full size. So that sort of dichotomy or like thinking, you can express it, you can manifest it in your position size, and I'll just take half the size.
Mm. Yeah, that makes sense. Does does uncertainty around a market or event-based news change your positions at all, or do you allow the trades to just execute either at take profit or stop loss as you originally designed?
The originally designed, the exits are completely mechanical.
Hmm.
So my decision will be the discretionary is to get in to actually take the trade and how much I bet on it.
Hmm.
So
Yeah.
I can take half a position if I'm not too sure about it.
Okay. So I know a lot of, or I assume a lot of this work is showing up in what you teach and what you're doing at Smart Trader Systems. Is that your more recent company that you founded?
Yeah, actually, yes. It will be launched very, very soon.
Okay.
And I'm hoping to share the few things I know about markets with others, give them some ideas as well.
Hmm.
And I will start with the MACD. There will be a free version and a more advanced one. And also, I would like to thank you and Tom for helping me code it because I'm absolutely hopeless with PineScript. I couldn't code PineScript even if my life depended on it. So I would like to thank both of you for helping me. Well, actually, you did the work for me, and we'll be publishing it in TradingView very soon.
Hmm.
And I would like to thank both of you, and that will be our contribution to the TradingView PineScript community. And I'm hoping they will find it useful.
I hope so too, and we appreciated having the opportunity to work with you on it. We're excited about it as well. Like I mentioned earlier, I have used MACDV quite a bit in some of my algorithmic strategies. It is a useful indicator for oversold and overbought territories. But since we haven't quite covered it, can you give us a high level understanding of the MACDV, the indicator that you've created, and what went into it, and really how it works?
Absolutely. Well, the indicator started long before it was published. It started with a question around 2014, because I've always considered momentum as a big principle, like a first principle, as John Bollinger calls it. And from all the tools I was using at that time, they fall into two categories: either range bound indicators, sort of like the RSI, the stochastic, or unbound indicators like the MACD, rate of change, and so on and so forth. And each one had its pros and each one had its cons. I wasn't like 100% happy with each type of category of indicators. I found that I had to keep switching between indicators from one category or to the next. And so around 2015, I said, okay, I'll try to, is it possible to create um, an unbound indicator that has the advantages of a range bound indicator? Because the range bound indicator has the advantage of it if it's scaling 0 to 100. So it's comparable across time and it's comparable across securities. So for example, the RSI, it oscillates from 0 to 100. The 80 reading is stable. You can go like 50 years back, 30 years back if you got the data, or you can compare securities that have a completely different absolute price, like the Euro, the Dow Jones,
Hmm.
and it works fine. But the problem is goes 0 to 100, which means it gets pegged at high levels when there is a trend. The divergent signals are not as accurate, and so on and so forth. And that's a function because it gets, pegged at high levels. I mean, the market can keep trading, but it can't expanding, adapt with the market. So the MACD is at the opposite side. It can adapt with the market. It's much, much better as when there is a strong trend,
Hmm.
but it's an absolute price indicator, just two moving averages, and it just gives you the final reading of the indicator depends on the price of the absolute price of the underlying market. So you cannot compare the MACD of one market versus another one. You can't even compare the MACD of one market if it's changed substantially across time.
Hmm.
So and that was my first. I said, okay, let's try to normalize a range bound indicator because I cannot unbound a bound indicator. So I have to normalize, and then unbound. And okay, the first, of course, idea was to put it in percentage terms. Obviously, that was not my idea. Someone else had thought about it before. I think it's called the PPO, or percent price oscillator. Some call it MACD percent. But although it was in percentage terms, it still didn't solve the problem because it was normalizing across time for a particular security. If you take the MACD, for example, 12 minus 26, divided by the value of the 26 and multiplied by 100, to put it in percentage terms, it works fine. But it works fine for one particular security in terms of finding overbought and oversold.
Mhm.
If you take the same overbought and oversold readings for a different market, you'll find that completely different. So as I mentioned in the paper, probably in the paper I wrote, um, if you take I took three completely different markets. For was fixed income, the Bund, German Bund. Then the S&P 500 also had natural gas, and the overbought and oversold readings for the MACD percentage, the PPO, were completely different. So, if memory serves, for the Bund was 0.7%. For natural gas, it was 7%. So it was like 10 times over. And so basically, to cut a long story short, you can use it for one security, but you have to keep optimizing and finding the overbought and oversold levels if you want to be switching from one security to another. So basically, it's not that useful. So my next question was, okay, why does this happen? Because a percentage is a percentage. I mean, whenever we compare things in percentage, you put everything into perspective, but not in this particular case. So I was kind of like getting puzzled. Why percentage don't work? And then I found out that volatility.
Mhm.
Fixed income markets are a lot less volatile than a market than natural gas. So perhaps that's it. So I try to normalize instead of price, normalize by volatility.
Mhm.
And then Eureka, then it happened. Then they found it in 2015, normalized by volatility. I started, putting, first check it visually. I said, this seems to be working. Then check it a bit more quantitatively, and I found that it worked. I said,
Mhm.
look, kind of like cracked the code, and it opened up a lot of opportunities for many pattern recognition, uh, for many patterns that couldn't exist with the classic MACD, because the classic MACD, all you could do was say, is the MACD above the signal line or is above the zero line, and perhaps change or check for divergences. But now, since you've got specific levels, you can filter out which signals you want to be taking and which you don't. It created overbought and oversold levels. It created a lot of patterns which would not exist, because you couldn't put in a normalized scale, and thus you could not say this is strong momentum, this is weak momentum.
Mhm.
And then sometime around 2022, I wanted to tell you this, I wanted to share this with the community. And I said, okay, I'll write a paper. And then I found out there were two, organizations that had these competitions. I said, okay, I'll submit it there. Uh, but I never thought that it would be awarded, to put it this way, because
Mm.
from the time I started creating in 2015 up until 2022, when I first, I showed it to, made it public knowledge, I had done so much work that by that time I thought, no, man, this is too simple. It can't be, I looked down upon it a bit. But actually, it proved to be, accepted by a lot of people, and I'm very happy. Not for that, I'm just happy because people can find it useful. I
Mhm.
think I could share some of that, the results. That's what I really liked about it.
Yeah, I think that's a strong insight there too, is that sometimes simplicity is what makes for a good indicator or a good strategy. Overcomplicating things can often lead to an approach that maybe works for a very short period of time, but not overall in terms of reading or measuring or trying to forecast the market. Uh, I found its simplicity to be And I do think that the ATR or volatility normalization makes a ton of sense in terms of using it as a relative indicator across different assets, or even different symbols within the same universe. In theory, you could be tracking 10 or 20 different stocks and use MACDV as a way to rank their current oversold or overbought ranges, normalized and relative to one another. So its usefulness extends beyond multi-asset or cross instrument, but even within a single universe of stocks, for example, right?
Absolutely, absolutely, and I think one of the advantages is that you can truly get a sense of overbought and oversold, being an unbound indicator.
Hmm.
So I've seen many times because the what I call the risk range when market starts getting a bit overbought is above 150. But if you observe a market can go to 350, 250. There is no stopping in terms of like, so if the market expands, the indicator goes along with it. So you can get a sense of truly how much the market expands, upside or to the downside. And since you have normalized it, basically it's momentum purified by its volatility. So when it's above 150, you basically have momentum that's 1.5 times its volatility. So you have purified momentum.
Hmm. Yep. Makes perfect sense. So I know that there were some improvements that I think you've made to the indicator over time as well. Can you tell me how MACD-H plays a role along with MACD-V?
Yeah, well, the MACD, the MACD, the histogram was the natural next step because it was created by a gentleman called Thomas Asprey.
Hmm.
So I thought, okay, if the MACD is normalized, then the histogram should be as well, because it's nothing but the difference between the indicator and its signal line. So I plotted it down and then tried to look for overbought and oversold readings, and lo and behold, it worked. 40-50 to the upside, 40-50 to the downside, and it's a measure of short-term overbought and oversold. So that was the next logical step. So it worked very well for short-term overbought and short-term oversold signals. And so the next step from that was, can we apply it across other normalized indicators? So I created the whole suite of unbound normalized, volatility normalized momentum indicators, sort of like the Kopok curve, or Linda Raschke's 310 oscillator, which basically is a MACD, 310 settings, or Alex Elders's systems. So basically, you can normalize all the classic unbound indicators of technical analysis. You could volatility normalize them.
Mm, yeah, that's clever. I hadn't thought about applying it to other unbound indicators.
Yep.
MACD is definitely one of those unbound indicators that has such large extremes that it makes a ton of sense to try to normalize it in this way. Uh, but I think there are other useful momentum indicators that also have these wide ranges of absolute price that are useful in this context. Um, so are there maybe one way to describe this from a quantitative perspective is that the final version of MACDV ends up being what we would call a stationary input. In other words, the values are bounded in a way that makes it useful regardless of where price is going.
Mhm.
And that factor that we're talking about is what's referred to as stationarity in quantitative algorithms. That's a useful input, especially if it's consistent over time across multiple assets, multiple symbols and tickers, and so on and so forth. Is there, in your opinion, an opportunity to use this, even if coupled with other indicators, to build something that's truly automated in markets and an automated trading strategy?
Yeah, absolutely. But as you mentioned very correctly, the key word here is to do that using other indicators as well. So, for example, other factors like volatility
Mhm.
itself, um, trend or fundamentals. But absolutely, yeah, you can use it, or you can. My preferred way is to use pattern recognition to basically, and that's have for a more advanced version of the MACTV, which is basically to locate the local. maximum and minimum of the indicator and basically quantify divergences and have them in a very robust and objective way. So basically, what I wanted to do is what you see on the chart and say, okay, made a swing high here, swing low there, and the indicator did this. How can I quantify this? So when someone sees it, they say, this is exactly what I'm seeing on the chart, and it doesn't become too esoteric because there obviously quantifying divergences is not something that I invented. I mean, there have been many attempts to it, but what I didn't like was that you don't understand what's going on behind it. I mean, what are the rules? What is the logic between the divergence? So in the more advanced version, yeah. So when you see swing high one, so I've got them numbered as well and labeled. So when you see swing high, momentum high one, momentum high two, because what I do the labeling of the momentum highs and lows
Mm.
uh, from right to left. So it keeps updating. So when I've got that done, you can see it makes absolute sense. Yeah, you can see it's high one, high two, high three, and then you can play around with the settings. So that one is higher than that one. So it's making higher swing highs and higher swing lows. So basically, you're just quantifying what you see already on the chart.
Right, right. Which sounds like the formation of trend following. You might even label this as Elliott wave moves if this were an impulse wave, right? If higher high forms or lower or higher low forms, and so on and so forth. It sounds like you're labeling that, but by using a different indicator.
Absolutely. Although my work was inspired from the work of Art Merrill, not so much Elliot. I mean, with the exception of one person, and that would be my good friend Tom DeMark, which has quantified quite successfully Elliott wave. I
Mm,
haven't found anyone else that has managed to do a convincing job of. Maybe I'm not saying that there aren't. Maybe haven't come across them, with the exception of Tom DeMark. Um, so my inspiration was Art Merrill's work, M&W patterns, which of course is also harkens upon the work of a gentleman called Levy.
okay, yeah, that's good to know. We'll try to add some links to that in the show notes. So, can you tell us a little bit about what you're working on next?
What I'm working on next is the launch of the website and the company.
Hmm.
Uh, so it should happen very, very quickly. I'm trying to do this as my birthday present before July. So this is my next project, and I'm really, really looking forward to it, to share my approach and solve the problem of how can someone be rules based, be systematic, but also have some form of control over the final decision.
Hmm.
I'm not saying that it is the way, it is a way, but if someone has a character or an approach compatible to mine, that will make sense. I'm not saying that it will be for everyone. Um, you can fully make it systematic if someone wants, but I've always believed that each one should be rules based and, of course, combine technicals and fundamentals.
I love that. That's exciting. And the site that you're looking to launch, you have the domain already set for that?
Yeah, absolutely. It should be my name, www.alexspiroglou.com.
Great.
I thought about doing smart trader systems, but I said, no, I'll make it difficult. I'll put my surname on it.
And for those who are struggling with Alex's last name, Spiroglou.com.
Perfect. Yeah, there you go. That will be definitely memorable after a few times.
For sure. We'll make sure to link that in the notes as well. How else can people get in touch with you? Are you on socials, Twitter, and all of that?
I am on almost all socials, but I'm more active on LinkedIn.
Okay.
I'm also having on Facebook, Twitter, but I don't do much posting. Basically, I like Twitter, but there is a limitations to how much you can put. Plus, um, now that I'm since in the launch phase of the company, I haven't put too much effort in marketing. I would like to have someone do cross marketing, like if I post in one social media, then it can be cross-posted across to others.
Mhm.
Obviously, it will be, someone else will do it for me. But you can definitely catch me on LinkedIn. I like it because I find it's very transparent, and I don't know. I like LinkedIn. It makes more intuitive sense to me.
Okay. Well, we'll put your LinkedIn profile there as well. Well, thanks so much for sharing all this with me, Alex. It's been good to, get to know you a little bit more, especially your history as a young trader at 13 or 15. And that's a good age to get started for sure, I think, because now you've had plenty of experience before you launched a successful career in doing this. So thank you for sharing your story and joining us here today.